Okay, it's time to get going. Good afternoon, everyone, and welcome back to Best Practices in Community Associations. I'm your host, Tim O'Keefe, an Executive Director and Partner with KW Property Management and Consulting. Back in March, KWPMC started this webinar format to discuss the weekly changes and challenges faced by community associations as the COVID virus consumed all of us. Although the virus is not yet under control and there's no vaccine in sight, we have learned in many respects how to move forward with our day-to-day lives without being quarantined. As a company, our COVID-19 protocol continues to evolve weekly. We share these changes with our staff and owners in buildings that we manage. Over the past month, we have seen a significant spike in COVID-19 cases. Florida now has more than 580,000 reported cases and nearly 9,800 deaths. Miami County alone has 147,000 reported cases, or about 25% of the state's total number of cases reported. Broward has reported 67,000 cases, and Palm Beach County has reported more than 39,000 cases. Each of these counties has doubled in reported cases since our last webinar just 30 days ago. Although the number of cases spiked in mid-July, the number of new daily cases has significantly dropped in August. We now have students going back to college and back to high school and lower level schools, so it seems reasonable that new cases will begin to increase again. Today we will use our best practices webinar to tackle another timely and relevant issue for all community associations. We will discuss budgeting and what all boards need to consider for the 2021 financial year. Yes, the coronavirus has had an impact on every association this year, and it will likely impact your 2021 budget as well. So let me introduce our panelists. They're going to take it from here and really get us going today. We are delighted to have two of the most knowledgeable budget experts in the state of Florida. They will guide our discussions on budgeting and best practices today. We're joined by Monty Kane. Monty is one of the best known and most respected CPAs in the community association management business. A few years ago, Monty merged his CPA firm, Kane & Company, with one of the top 40 accounting firms, MBAF. Monty is a principal with MBAF, and it's a pleasure to have you join us again today, Monty.
Tim, thanks a lot for having me come, and it's nice to also participate with Roxana today.
Our pleasure. We're also joined by Roxana Dorigo, an executive director and partner with KW Property Management and Consulting. Roxana is a CPA, and she's responsible for our client accounting services for hundreds of community associations. I can assure you that between Monty and Roxana, they have personally created and reviewed thousands and thousands of association budgets. If you have a budgeting question, they will have an answer. Monty and Roxana, thank you for joining me today. Our webinar participants are in for a real treat. We had over 170 people sign up, and they're still joining. We've got about 70 online today at this point. So as they continue to add, we will get started. So let me start with our first question on timing for budgets. And if we could move to the next slide, I want to show just some of the topics that we're going to be talking about today. We're going to talk about budget, timing budget. We'll talk about surpluses and deficits, reserves. We could probably spend the whole time we have today just on reserves, but we won't do that. The importance of contract management, how budgeting payroll makes a difference in your budget for the year, the impact of COVID-19, and we'll talk about how budgets lead to audit preparation as we get toward the end of a year. So timing is good for these conversations. If we can look at the next slide, we talk about timing of budgets. So Roxana, I know that I want to start with you from your standpoint. When does budget season start for KW Property Management properties? And what is the process that we go through to get the budget season kicked off?
So for us, our recommended budget timeline is literally August 1st. So by August 1st, we issue a proprietary budget template to our property managers, who then have a month to create a draft of a budget for the board or for the finance committee or a budget committee. So for us, if you have not started on your budget, start now. Basically, that's the message. And the reason being is that there's a lot of things that come with a budget, one of which is you need a 14-day notice. You also need time for the budget or finance committee, or maybe the two board members to review the budget, to have time to review it, analyze it, give feedback back. Then we have to, readjust, and that takes time. So by starting by August 1st, you can meet the deadline of, depending on your governing documents. For us, it's 60 days prior to the end of the year that we want to communicate with the owners, make sure that they know what the game plan is for next year, whether there be no increases or increases to the budget. We want to communicate that. So it's very important to start now if you haven't done so already.
And so, Roxana, I know you've got you wrote an article years ago, and you used the word budget as an acronym, and we can see it on the screen. Can you kind of walk through the concept of budget, and from a timing standpoint, why each one of the letters in the word budget means something special to us?
Yes, absolutely. So B was for budget your time. One other recommendation along with that is, why don't you mark your calendars now for that goal in place? So read your governing documents. Do not assume that all governing documents say 30 days prior to the end of the year, because that is a common provision in governing documents. But I have seen governing documents and bylaws that actually say 90 days prior to the end of the year, you should have communicated to your owners, at least a mail out to the owners, what your budget will be. So that is step one, budgeting your time and putting those calendar reminders of where you should be in your budget timeline. So when do you want to meet with your board on your budget draft? When do you want to do the mail out, which is 14-day notice for condominiums, and put it on the calendar. Make sure that your board is also aware, and you invite them, or the finance committee or the budget committee, to those timelines so that they understand what is the timeline for your budget to be ready.
So let me ask Monty a question around that, Roxana.
Sure.
Monty, timing is very important, and I'm sure you get called with panicked people about, I need help, I need something to be done. Like, why is timing important from your perspective and the thousands of clients that your firm works with? Monty, you're on mute. No, you can go ahead.
So that's just something that my wife likes, but I don't think anyone on this call likes that. So having said that, timing is very, very important. It's also about compliance and also about making sure that we don't cause disasters. So part of what I consider Roxana and myself, or what other people refer to as financial doctors in the condo sense. And as financial doctors in the condo sense, it's about keeping a healthy state of financial position and of the association. But when it turns from healthy to unhealthy, is trying to find out why and how we can prescribe to you what you need to do to make the changes. But timing is very important in every aspect of every financial decision.
So that's a good headway to the letter U in budget that I used in this article, which is understanding your balance sheet items and the effect on the budget. Really what I mean by that is understanding your financial condition. So if there is a deficit, what are you going to do about it in the next year? If there is a surplus, what are we going to do in the budget next year? And that takes time, because there's discussions. There may be a lot of opinions in the finance committee, your budget, or even the board as to what to do with a deficit or a surplus. So timing of, again, saying start now if you haven't, because you need to understand your financial condition. And the statute actually talks about financial condition in some way. It just says that during this budget time, you should address it. You should talk about it. You should make your owners know if there's a surplus, what's going to happen with that? If there's a deficit, how are you going to deal with that in the next year? It never says what you need to do. It doesn't say you have to remedy a deficit within a year, but there's got to be a plan, and it needs to be talked about during this during the budget season.
So to that point, Monty, as we get to the end of the year, many properties have budgets that end up, they have surpluses or they have deficits. So what options do properties actually have in handling a surplus? And then we'll get the same question on a deficit.
So as far as a surplus is concerned, first of all, you put a thumbs up because you have a surplus. And then hopefully you've actually, even as part of monitoring the year, you know that you're running a surplus, so that when it comes time to the budget process, you may be able to use part of that surplus, all of it, to reduce the assessments in the following year. So that's one consideration. There's always a possibility that you may want to also bring your reserves to a higher level, and you can use your surplus for that. So surpluses are like a plus. So we'll talk about minus and we'll talk about pluses, but that's something we love to talk about. It's also nice to know you're going to have, and also nice to know whether you really do have a surplus or not. Maybe you need to take a look to see whether or not there may be expenses that haven't been recorded yet.
And Monty, if you have a surplus, is that taxable?
Well, that all depends. Hopefully we try to take our paintbrush and take a hard look at the numbers there to see whether there are expenses that are related to the taxable forms of income that could be in each association. So interest income and potentially things such as parking space income and other rentals could be subject to taxation. Generally speaking, though, your surpluses are not taxable, generally speaking. And that depends on the methodology in which you're filing the tax returns. So it's a little bit of a complex matter, but it's something to be looked at. And for sure, I would say that if you see you're going to have a surplus, that's another question you ask. Do we have taxes to be paid on it? And get that answer now, not by March 15th or April 15th of 2021 when the taxes have to be paid.
Very good. Okay, Roxana, we've got the B and the U.
Yeah, so next is D, divide and conquer each section of the income statement. Again, you know, approaching a budget may be a daunting task and somewhat a little bit overwhelming, but really if you take your time and start as soon as possible and can budget your time as a manager, first of all, looking as a manager, looking at basically the income statement, there may be a lot of lines, but if you can just divide and conquer every section, you will be successful at the end and you will have addressed everything. And just talking about revenue and expenses, you know, always think about a conservative view, meaning when there's revenues, think about all the type of revenues you're going to have for a year. It should be in your budget. Contractual income. When I talk about late fees and finance charges, just as a recommendation, do not inflate those. If there's a projection in your budget that should be there, part of your review of a budget should include at a minimum last year's budget, year-to-date projection for the year, so that you have a guiding force for each section. And one of the things I always talk about in other income is late fees and finance charges. We don't want to inflate that. Because one of the things that, what do we do when an owner comes in, they're a good paying owner, and they missed one payment because they were on vacation? The first thing we do is we write it off, we waive it, maybe based on, you know, the collection policy at the association, and there goes your revenue for the year. So you don't want to inflate that. You really want to put a conservative amount when you're looking at other revenue. Basically, what we recommend as a best practice is only include revenue that has a contractual or legal obligation to make a payment to you. That would be the best option and conservative view when including other revenue. And then when you look at expenses, also be conservative, meaning when there is a contract, put it in there. If there are projects to be done, put it in there. You have to do a game plan for the next year. So again, divide and conquer each section and make sure that you're including everything that is pertinent to each section of the income statement.
And so Monty, when back up to you know, the financial statements, you've got your balance sheet and your income statement. oftentimes when you think about budgeting, you're really kind of focused on the income statement because that's where your expenses are, that's where your revenue is. What else would you look at on your balance sheet and glean from your balance sheet that would impact or help you in creating your budget for the following year?
That's a great question, Tim, because your balance sheet is your statement of financial position. That tells you, are you healthy or not? And if you're healthy, it's going to be evident because you're going to see that you have plenty of working capital and plenty in your accumulated fund balance. So your accumulated fund balance is the same as retained earnings in a corporate environment. And the excess of your assets over your liabilities represents your fund balance, your retained earnings. And the question is, how does that number compare to the annual assessments? And generally, as a rule of thumb, you want it to be at least 1 month, but up to 2 months or more of your annual assessments. That's how you really take a quick look at it, providing you have all of your assets in your financial statement properly and you have all your liabilities down. So that's really important. The second part of it is to take a look, even if it's in good financial health, what about the receivables? Is there a trend going on? Today, we have unprecedented circumstances. So we might be seeing more bad debts, and we might need to see that we need to add to our bad debt provision, not necessarily write-offs, but bad debt provision. So we're taking an allowance against that receivable to really state it at what we expect to collect in line with what Roxana said. You want to be just before, if you're not expecting to collect late fees and things like that, be real about the time, but also be real about the maintenance assessments receivable at the same time as well.
Very good. Thank you, Monty. All right. Back to you, Roxana. We've got the timing and and understanding the balance sheet and income statement. Now we come to G.
G, gather all your contracts. So this is a simple one. Have literally a binder with all your contracts, because inevitably every time there is a budget meeting of any sort, there's always a reference to the contracts, and it's better to have that contract there with whatever the potential increase may be for the year, if there is one. And also make sure that when you're making an adjustment to your contract lines, that they are on the anniversary date. So that's something else that we always talk about and we train our managers on, is that when there's an anniversary date and the contract is in place and it calls for a 3% increase as an example, but it was signed and started in June, that anniversary year and that increase in 3% is actually only for 6 months of the year. So just as a reminder that increases, any negotiated, pricing is usually based on the anniversary date, which does not mean affecting a budget for 12 months, but maybe it is for 6 months, depending on the anniversary date. So having those contracts handy to talk through that in a budget setting has saved tons of time. I've been in meetings where the budget process many years ago was not in place. The contracts were not there in the binder. For KW, we have a budget binder present at every meeting, plus a contract binder. And anytime that contract binder has been missing, the meeting goes from an hour to 3 hours, because now everything gets questioned, because we didn't have that quick answer of when is the increase and when is the anniversary date. So that's just a recommendation from us, to have that contract binder ready and for your budget.
All right, Monty, comments on that?
The only comment I have is really a question for Roxana. So when you're doing the budgets for 2021 and you have a contract that is expiring on June 30th of 2021, but you don't know what the rate increase will be, how do you approach that?
So we call the vendor. We call several vendors actually to make sure that we get a quote and get an understanding of what that may be. So it's also not being afraid of calling that vendor and making sure that you get that information for budget purposes.
Okay, thanks.
That's a great question. Okay, so how about E? What's E all about,
So
Roxanne?
E is evaluating collectibility of delinquent unit ledgers, which is something that Monty touched upon earlier. So now with COVID, it becomes a little more important, right? Because there are some people that have financial situations where they may be not paying their assessments. And where we've seen a trend is when a condominium or a place, an association has more than 40% investors, meaning renters. We've seen an increase in receivables in this area. So for next year, for 2021, how do you account for it in your budget is through the bad debt expense line. So we're going to have to be very careful in analyzing, and what we've been doing is every 15 days, we've been providing those particular properties, the board, the actual receivables, so that they could see the trend that it's trending upward, and that at the same time, just thinking about the budget, the bad debt has to be aligned with the potential loss of assessments because of those investor units, which is where we've seen the increase mainly, and the effect that it will have in 2021.
I have a question for Roxana. Are there ever situations where the association, when the delinquencies grow to a certain amount, can step in and collect the rents?
Absolutely, yes. That should be part of the collection policy, right? So after the 90 days, which is where I think the statute allows you to go and garnish the rent for those that are 90 days past due.
And then can you kick them out if they don't pay?
No, but you could actually restrict their use to certain amenities.
Okay.
You can restrict their access to their unit, but certain amenities.
Can you restrict the access of their pets to the units?
No.
That might make them pay in a hurry.
That might make them pay. That's a good strategy, but no.
It is kind of interesting though, that question, Monty, because just because somebody's not paying, the Fair Housing Act gives them quite a bit of protection. So you can't just go in and say you're evicted. The Fair Housing Act gives them time in order to either get current or find another place to live, but
Right.
You can't just throw them out immediately.
Yeah.
Question for you, Monty. You've seen a lot of budgets and a lot of different properties. In today's market, what would you estimate being a normal delinquency rate for an association?
Well, up until March, I would say that generally speaking, when there's very few delinquencies, I see that many budgets are put in with 1% or something very minor just to have a line item in the budget. But now it's a different story. And I think that there's not a stated percentage. So I would say that maybe if you don't see much happening, you might want to notch it up to 2 or 3% just to be able to catch up. Because if you don't do that and next year gets worse, you're going to have to be collecting for 2 years for the balance of 2020 and 2021. So you would notch that up even just to be conservative. So you might go to 3 or 4%. If you start to see delinquencies in 2020 as we get close to the end of the year, and of course we're doing the budgets now, so we've only had 4 to 5 months of this, I think you just have to be ultra conservative and assume even a worst case for 2021. And if you're wrong, then at least you erred on the side of being conservative.
And Roxana, what guidance are we giving our customers as far as bad debt and what percent?
Similar to what Monty said, is like, let's assume COVID is still around. COVID is going to be around into 2021. It's inevitable, most likely. And, we have to evaluate not only where they are now, but that potential additional delinquency that we may see in 2021.
And I would just add that COVID we may have a vaccine and we may see reductions there, but the lingering effects of the unemployment that we have now So many workers who have not found full employment again, and so many jobs change because of technology and permanent loss of jobs, does mean that the lingering effect can't be predicted at this point.
Yeah.
And of course, it depends what party you're in. You might predict it's going to end early, but really we just have to look at it as a nonpartisan people there in terms of, yes, there is a lag time. Anytime you go into a recession or you see an economy that may be on the downswing, and certainly with South Florida dependent on hospitality jobs, our airports, our ports, it doesn't look great for us at this point. We know that occupancies are very, very low. We know the cruise ships are not doing that well. So it's going to take quite a bit of time to catch up. I can't predict that for you right now either.
And, you know, last month on this webinar, we had the Director of Emergency Services, Jared Moskowitz from the state of Florida, which is a big job. And, you know, his position on it was, you probably can't expect to see a vaccine for another year. So let's say it's end of first quarter 2021 into second quarter 2022. But then once the vaccine's available, we only need 300 million vaccines for the United States. And then are you going to be the first one standing in line, Monty, to get your vaccine? You're going to wait 90 days to see what the impact is on people. So it's not going to be an immediate cure just because we have a vaccine. It's going to take time for adoption, acceptance, and people standing in line waiting their turn.
Of course.
So we're probably a year away before we can start to feel like, hey, maybe we're getting out of the woods a little bit. It's going to take some time.
What's going to happen to all the vacant offices? Since I've been working at home for now 5 months, what are we going to do? What's going to happen? That's a major issue. You know, real estate, this is an economy in South Florida dependent on real estate, rental income, commercial and residential. So it doesn't look good at that end. So, you know, let's hope for the best. And plan for the worst.
Here's a question that came in from Audrey, and she said that you stated that an item on the balance sheet should be 2 months or more of annual assessments. What was that item? She didn't catch it.
That item is what we call the fund balance. So the fund balance is calculated, if it's not evident on your balance sheet, by taking the total assets and subtracting out the total liabilities. And that represents everything in your fund balance. And that we're talking about.
And as a recommendation of, you know, we do request 2 months of operating expenses, which is what you mentioned, Monty. That is reasonable, especially in a hurricane-prone, you know, state.
And I just want everyone to to understand that fund balance under our new accounting rules for the reserve fund. Those reserve fund balances are no longer included in the fund balance. They are included as a liability on the financial statements because of changes in generally accepted accounting principles. Not all of you may have had those changes made in your December 31st, 19 financial statements, but at some point it will be made, hopefully when your auditors come in and make the adjustments. And I know
We
KW
have changed.
Yes, I know.
Yeah, KW has changed the presentation in the financial package. And it is strange to people as they're reviewing it, but we let them know how to we are reconciling, you know, the reserves still to the cash, so they feel a little more comfortable in that.
And we'll hit on that a little bit more detail because I want to drive that point home to everybody that there has been a change in reporting for reserves, where it doesn't show up on the income statement anymore. It flows through the balance sheet. We'll talk a little bit more about that from you guys that are the experts that know what that means. But let's get to T. That's our last letter here. We've got, we're almost.
There was one other question someone asked about adding a GL line to a worksheet. So I don't know.
Yeah, well, let's finish the T and we can come back around.
Okay.
That question's coming from a manager, and that was a question from a manager.
So tally the results. So at the end of the day, is there an increase? Are you staying flat to budget? Have you met the expectations of the board? So something else to do during this time, if you haven't done so, is talk to your board. Talk to what their expectations are for next year. Whether or not we can match it, because, you know, COVID will be playing a part into 2021. But tally the results is really just talking about the increase and making sure that you're meeting the expectations of the board, finance committee, budget committee, and understanding the effect that it would have on the owners. So typically we see an increase somewhere between 3, maybe up to 4%. That is typical. When you go higher than that, then you start questioning reserves, you start questioning projects, you start questioning, are we using these funds for a major capital improvement of some sort? Are we taking it from the right fund balance, meaning there is a reserve, actually no more fund balance for reserves, but are we taking it from the right, monies, whether it be operating or reserves? And so tally the results is really focusing on what is the effect to the owner, what is going to be the increase. We never talk about decreases because, there's such thing as inflation and there is such thing as contracts, with already negotiated increases in it. So
well, I will say this.
Do not do increases.
It's not a dirty word to say you're going to have an increase in your budget. We go to a lot of properties, and one of the things that we do when I get to a property and it's KW, we assess property values. And the properties that continue to invest in themselves see their property values tick upward on a regular basis. Those that don't invest, we see properties that brag that they haven't increased their maintenance fees in 20 years, and it looks like it. And their property values don't keep up with their neighbors. And so there is an impact by not increasing your budget or maintaining your building properly, ladies and gentlemen. So don't fall into that trap. A bit of an increase, it might be on a monthly or quarterly basis. It might only be $15 or $50 a quarter. Most people can afford that. So it's not a bad thing to have an increase so that you don't see your property deteriorate over time. Because I can assure you, if you have 200 units and they all deteriorate by $20,000 or $50,000, that's going to be way more than what the annual increases would have been had you done the right thing to keep up with maintaining the property. So just a little advice there. So I'm going to move on to something else, Monty. We're going to jump into reserves. Roxana just talked about reserves when she's talking about tallies. Does a budget have to include reserves? And is it different for an HOA versus a condo?
So for condos, budgets must have reserves. That's in the Florida statutes. That doesn't mean that the owners at a duly called meeting can waive them. They can waive them if it's a properly called meeting, it's a vote of the membership, or it's done by proxy. So that's required in statutes. Now for homeowner associations, the rules changed several years ago where for the most part, homeowner associations under the Florida Statute 720 do not have to have 720 do not have to have reserves in their budget. But once you put reserves in your budget, once you start funding for reserves, you have to meet the same criterion and put them in your budget from that point forward. So it's a matter of giving the board the option at some point in time, if they haven't done already, to go ahead and start putting in your budget. And once you do, now you're under the same type of guidelines. Would you agree with me, Roxana?
Yeah, for homeowners, HOAs, the reserves are created by 2 ways. 1, by a vote of owners, or 2, by developer budgets. So if the developer built it into their budget from day 1, then it's statutory. It's considered statutory. If the owners voted on putting in the reserves into the budget, then it becomes statutory. Anything outside of that is called voluntary reserves. So that's a little bit of the difference between the condo, where you already mentioned in 718, there is a requirement. There is a requirement to have reserves. It can be voted against or lowered by any, by having an owner vote. But the HOAs, not necessarily do they have statutory reserves. There could be voluntary, or they could have no reserves established.
But Roxana, is it true to state that in a condo, specifically for a condo, you are required by statute to budget 100% reserves? Doesn't mean you need to go forward with it for after you vote, but you have to budget 100% reserve for a condo.
Are you asking me if that's what it should be?
Yes.
Yes, based on a reserve study. So we always recommend as a best practice to have a reserve study. If you don't have a reserve study, you're going to be faced with a manager who has to call experts in to give them estimates on how long does the roof have as a useful life, or how much would it take to replace a roof, such as an example, versus a reserve study where an engineer comes in and basically looks through your whole property. You should have one member of the board as a recommendation. Again, a member of the board and the manager walk with that engineer, because you are the better information for that engineer. If something has been replaced, he should know about it. And then the reserve study is really our guide to what the contribution should be in the following year.
Okay, and then on the reserves, explain the difference between being fully funded versus the process for getting partially funded or no funding at all.
So it is a membership vote. It is not a board vote. The board can decide as to the method of calculation. So there are two currently in the statute. There's straight line versus pooled reserves. So the method can be decided by the board, but the partially or no funding is a voter, an owner vote to accomplish that.
And how do you get that vote? How do you go about getting that vote for a condo?
Well, there would have to be a ballot. It is something very formal. For us, we recommend having the attorney review that ballot, make sure that it is properly stated that if you're voting against reserves, there is a wording that has to go into that ballot that says that by not voting to have reserves, there's this potential in the future that there would be a special assessment, because where else would the money come from to replace a roof or paint the exterior of a condominium or redo a clubhouse for our HOA. So it's a very formal vote that will go out with the 14-day notice of a budget. It's upon that where you get the vote and the ballots.
And it's interesting because if you go building by building in different parts of the state of Florida, you will find tendencies to either have reserves or not have reserves. On the West Coast, and we have a lot of attendees from the West Coast of Florida listening today, it's almost unconscionable not to have reserves funded at 100%. But on the East Coast, the preference is in many cases to just special assess when you need the money and not have reserves. So it really is a cultural thing, building by building. To say there's a right way and a wrong way is probably not appropriate, but it's really whatever a particular board or building, the culture that they create around reserves kind of dictates how they're going to do that.
Why is there a difference between the East Coast and the West Coast of Florida? I'd like to know.
I'll give you my theory, since I'm from the Midwest, and my grandmother taught me that you always save for a rainy day. So all these Midwesterners that come down 75 end up on the Midwesterners come down, the 75, they end up on the West Coast of Florida. Everyone from New York and, comes down 95 and they end up on the East Coast. So the conservative are more conservative, the Midwesterners like me, and you save for a rainy day. So it's like, put that quarter in the bucket every time you drive out of the condo so that 5 years from now you can pay for things, versus on the East Coast, there's more of a mentality, hey, look, when I need the money, I'll special assess everybody. I'd rather keep the money in my pocket. When I go to the grocery store, I don't buy green bananas. So, that's kind of the mentality.
I think there's also a difference in horn honking. It's very little on the West Coast, but on the East Coast, there's a lot more horn honking too. So that maybe there's a lot less patience on the East Coast. Would you agree with that, Tim?
You have to explain what horn honking is. I guess we may have to have a webinar just on that. I know what husking corn is, but I'm not sure about horn honking.
Horn honking is one of the cars. I don't hear any noise in the roads on the West Coast, and the East Coast is a different story. It's a matter of patience, I think.
So one of the things that Roxana brought up, go ahead, Roxana, I'm sorry.
I just wanted to add something to the reserves, which is something I get asked a lot. If there's a requirement to have a reserve study, And I always answer the same way. Unfortunately, no. I wish there were. And I think many years ago, I don't know, Monty, if you know, but I think many years ago, before I entered the industry, I entered in 2008, that there was a requirement before. But now there's no requirement for a reserve study. However,
in other states, they do have a requirement to have that. So that really begs the question in terms of how good are the numbers for the reserves. And I know that you probably have dilemmas as a management company when you see the same buildings, sister buildings, doing it two different ways there. So they may have a reserve study that hasn't been updated in many years, and the other one has been updated. So the uniformity does not exist in this area for sure.
Our recommendation would be to have a full reserve study every 3 years and have updates built into the contract, updates for the the 3 years leading up to the full year of a reserve study. So that way you have not only the effects of inflation, but you also have the effects of what's happening in the construction industry. Because when developers are in, prices are going up. When there's a big, like down here in Brickell or downtown Miami, there's a lot of building. Those costs there may be different than in Fort Lauderdale, where you may not see as much because, again, the engineer is taking into effect the costs that are happening in the industry plus inflation. So you want that update on a yearly basis.
So Bill is asking a question, is the member vote required for reserve funding the same for HOAs and condos?
The vote is the same as long as in the HOAs, the reserve is statutory, which is established by either a developer budget having it or by membership vote. So the answer would be yes, as long as in the HOA is statutory reserves and not voluntary reserves.
Okay, thank you. There's another question that came in and we talked about this a little bit earlier, but Jeff wanted to know, how do we budget for capital reserves with the changing rules? And so I think the changing rules are the shift from budgeting reserves as an income statement item to a balance sheet item, and then when you recognize that income. So Monty, do you want to take that one?
So budgeting for reserves doesn't change based on the accounting pronouncement changes. So accounting pronouncements are just the methods that have been adopted by or put forth as requirements by the Financial Accounting Standards Board. That's an independent body that sets all of the standards. And so all they did effective for December 31st, 19 financial statements and thereafter is they made a new rule. And the rule is that your reserves that you had in your fund balance at the beginning of 19 now have to be restated on the beginning balances of your December 31st, 19 financials. So they have to be restated as liabilities. They call them contract liabilities. Basically, let me just try to explain it to you in layperson's terms. What it means is that those reserves are holy. They're like trust funds. Those are funds that were set aside based on a methodology, whether it was a reserve study or the board did their own study. It was set aside, and that's the remaining balance there. And basically it says that's a liability that the association has to be spent on reserves. So it's no longer a fund balance, which basically, when it was a fund balance, people might thought they could help themselves to that, or they can inflate the net worth of the association. So now you have to look to the balance sheet, to a liability account called deferred contract reserves, or just deferred reserves, basically. It depends. CPAs are using all different types of terminology, but it's deferred reserves liability. That's what it is. It will always be that way. Now, if you happen to have a surplus in the reserve fund, for example, from interest income, you've been investing it there, you don't have to have that go into your liability. That was not something that was assessed to the owners. It was earned while it's in the fund. That can drop to the bottom line. That can be part of your income statement. You can have a surplus build up in the fund balance, or some other types of income. Perhaps you've had a settlement that goes into reserves, and that settlement that comes into the reserve account would go into the revenues and would drop down to the bottom line. But if it's an assessment to owners that's done in accordance with the statutes or based on an HOA's making assessments, if it's an assessment, it must stay as a deferred contract liability in the reserve fund. It's different for the operating fund because in the operating fund, those amounts that are assessed are part of a budget that's supposed to be spent within a 12-month period, the cycle of the business.
And I think of it very similarly to prepaid insurance. So if you pay your insurance in advance, it sits as a liability on the balance sheet. Once you pay your bill, then it comes through the income statement, right? It's really very similar mentality. We just haven't been used to treating it that way.
Yeah, there's been a lot of opposition around the country. We have offices in many states, and many of our colleagues have been fighting us on that, but we've actually worked with a group of other CPA firms in South Florida and in Nevada to come up with a proper structure for this. And there still will be CPAs fighting, but I think they have a losing battle. It was just a lot easier for them before. Now, this was the year of change, and I think once we've had this year of change behind us, everyone's going to be on board. But yes, these are contract liabilities. They should be treated, and this is my opinion only, as like a trust fund. They're to be used for their purposes. Don't help yourself in the operating fund by using that reserve liability.
So there's a question that Wendy in Bonita Springs had asking. She said, is it better to use the operating expense account during the year for items that the reserve has set aside to continue to draw interest on the reserve amount, or then at the end of the year reimburse the operating account to pay it back? So I think you just answered that question, Monty, which is the reserve fund is not intended to be used for the operating account.
No, you'll be
Absolutely.
in violation of statute every month that you do that. So there should be an amount due to operating on your balance sheet. When you see that, it's a violation of statute. So something's gone wrong. So, something was paid out of operating that should have been really reserves.
And
not
also
a recommended, practice.
Yeah, it's also a fraud signal. You may say, well, that doesn't sound, I'm not going to, Wendy, Wendy, I'm not accusing you of fraud if you do that. I'm not saying that you do that, but basically the decision as to where it gets accounted for, whether it gets accounted for in the operating fund or reserve fund, should be considered a permanent decision when that expenditure goes out. Too many times we see expenses that should go through operations, an attempt made to have them go through reserves. And that's one of our risk assessments that we make when we do an audit. If we see expenses going through a reserve account, were they in fact all reserve expenditures, or did they try to shift some of that into the reserve fund? And that's a no-no. And if you hear board members try to push you in that direction, just be careful, because I've seen a lot, and subsequent boards come in and do investigations of prior boards. Boards have a responsibility to treat this as other people's money. So I really do appreciate that question, because I think it brings up this issue. Thank you for that question.
Yeah, like
Roxana,
something to add.
Extensively you've done a lot of educating our board members over the last year on this change in reporting. So what's the adoption that you're seeing, and what's the struggle that board members are having with this concept?
It's the repairs and upgrades. So I literally this afternoon, earlier, I had a meeting with a board, and they were struggling with their capital projects. Where is the money coming for these capital projects? So there was a mixture of components, one of which there were new reserve components. They were not existing. They were not there when the reserve study was made, and the owners have not funded for that particular capital improvement that now will be a reserve item for the future year, for 2021. And for the next time it needs to be replaced. But the actual first purchase of that enhancement or that capital project that is under the definition of reserves, but they're not in the reserve funding yet, should not be taken from reserves. And repairs is another big one, where you see a patching of a little area on the roof and it goes through reserves. That is not the intent of reserves. The intent of reserves is for the future life of the whole roof, not a repair of a leakage in your roof. So the answer to the question is you have to be careful to identify the component, make sure that it's there. It's not a new component that is considered reserves, but it's not in your current, listing. It would be in the future for the future reserves and repairs. And that's where we see a lot of errors, where repairs are going through reserves.
And so when you talk about components, what are the items that should be reserved for?
Well, it's for condominiums, it's a must to have the roof, exterior paint, and correct me if I'm wrong, pavement.
Right.
So, and anything that has a life greater than 1 year that is equal to $10,000 or more.
Okay.
And by the way, that $10,000 has been around since the beginning of time. They've never adjusted that for inflation. And you can go to your local congressman in Florida and see whether they want to change the rules, because I think people would be happy to see that level raised as well. Would you agree, Roxana?
Yeah, I think so. And then there's also a kind of question about that 10,000. Does it mean 10,000 per item, or can it be like a section? Like, let's say the lobby. You want to remodel the lobby. Are you going to itemize everything and say, well, this doesn't meet the 10,000? So a lot of it is a lobby renovation allowance is what I've seen, where it's for every item in the lobby. So it doesn't have to be one specific thing. It could also be like encompassing of an area, that every single item is not 10,000. It's just the totality of remodeling an area is in excess of 10,000.
Okay, so I know we're going to run out of time as the clock is moving quickly on us. But Roxana, for you, Paul from Naples asked a question. He said, we're relatively new HOA, and we're targeting to achieve an operating reserve equal to 6 months of annual operating expenses. Is that a good target?
I would need to know their actual components, and I would need to see where they are. 6 months, I don't know. I actually, I wouldn't be able to say that 6 months is a good number just to start funding, but I would want to see what is their funding right now. And 6 months sounds pretty good, to start funding, but it may be a partial funding, for that association. So
but I think what you talked about earlier, it's get a reserve study done, Paul, see what the reserve experts are telling you.
absolutely.
And according to that, and that could be 2 months, it could be 2 years. We don't know.
Exactly.
It really depends on what elements, components you have in your HOA.
Exactly.
Okay, and and the big thing in an HOA, probably the biggest expense for reserves is your roads. If you're responsible for your roads over the course of 25 or 30 years, you're going to have to do a lot of work on your roads, your sidewalks. If you've got trees planted and you have oaks that start uplifting the sidewalk,
drainage, yeah,
you're going to spend millions of dollars on that over time. So that's what you really have to get a hold of in an HOA.
That the 2 worst words for an HOA or a condo are special assessment put together. Those are the 2 worst words.
Yeah.
So let's move into contracts. Now, Roxana, you talked about the importance of reviewing contracts, knowing during the time of having a contract book, knowing the month that the contract expires and when you might see an increase, and budget accordingly for contracts. So we have questions that came in. One of the questions that came in from Patricia is, what should we expect insurance rates to increase in 2021? What have we seen? I think Alex also asked the same question. So what are we seeing and what guidance are we giving our clients for insurance increases?
For insurance, so it's a little tricky right now. I have not gotten the opinion of our insurance agents yet. I think this last year, there was a huge increase in insurance this year and last year in 2019, particularly because of the hurricanes. So the aftermath of the hurricanes may not come right away, but it comes in time. So for insurance right now, I don't have an answer, but definitely we are asking our insurance agents for that increase. I don't know, Monty, if you've heard already from the industry.
I have not, but given the fact that sea level rise is a fact in Florida, and many communities are trying to prepare for that, and given the fact that in a low interest rate environment, insurance companies are not going to make as much on their investment income to be able to support their obligations going forward, I would expect to start seeing some real increases. That's what I would expect at this point.
Yeah, in the
You know,
last couple of years,
go ahead.
sorry, go ahead.
I was going to say a lot of insurance companies, you know, have put a plan together that we'd be at much higher interest rates and the returns on their funds would be better. And knowing that they cannot do that at this point because we don't know when interest rates are going to go in any positive direction, it probably will impact their ability to put that on to the homeowner through the condo or homeowner association.
But as a recommendation, talking to your insurance agent is a must during the budget season, because again, they should give you in writing a potential increase that they in the industry know should may occur in the 2021, unless you have a renewing policy that maybe you will already know. But definitely speaking to that insurance agent is part of the process that we go through in KW. I just have not gotten it yet.
You know, interesting, I had a conversation with a couple different clients this week that had talked to their agents, and they both said that they could expect a 10 to 15% increase, but their contracts, their policy didn't renew until the second half of the year, so it wasn't going to be a full 10 or 15% increase impact in 2021 because it will be the second half of the year when it happens. So they weren't overly concerned about that increase. So those are the different things that you can look at when it comes to understanding that. Let's move on to the utilities. Roxana, are we getting any guidance from the utility companies on what to expect in increases?
They actually come out a little later, more in line with September. Early September, we could start looking at FPL and water and sewer. Because their fiscal year ends, I believe, is October 31st. So in September, they start talking about what's going to happen in next year. So we do definitely wait for that message. We literally go onto their website and there is very easy information to gather if there's an increase on fees. But it does start September 1st, around the early September, where we look at utilities.
Okay, great. And then let's move on to the impact that COVID-19 is going to have on budgets this year. I know we talked when we were going through the budget acronym, we talked a bit about budgets and maybe 1 or 2% impact on the accounts receivable in properties. That's a budget impact for bad debt. But as far as expenses go, Roxana, what are you seeing this past year? Because we know that there's some expenses that went up because people were spending a lot more money on supplies and even on labor. In some cases, the expenses were going up because you may have taken someone, if you had a pool attendant, for instance, say, I don't need a pool attendant because the pool's closed, but you need more people cleaning. So you convert people to cleaning. So What are we saying generally? Is there an increase, decrease? Is it a neutral impact that we're
it's
seeing?
Almost like a netting effect to what you're saying, because as a recommendation, if you haven't done so already, you should have separate lines, non-budgeted lines. Obviously, no one knew this was going to happen. So non-budgeted lines, keeping track of your supplies, keeping track of that additional help that maybe you may have reused existing employees to do the cleaning, or you may be hiring to do the cleaning of certain areas. So you want to track those non-budgeted line items separately to help you in 2021, because the impact will still continue, as Tim had mentioned, and Monty. We don't know what the impact is, but we have to make assumptions for budgets. So we could assume maybe for 2 quarters of the year, COVID is still in place, and we will have more cleaning supplies and personnel that has been repurposed. But there is a netting effect to to really answer your question, where there is COVID expenses, but at the same time, our managers have called the different amenities providers. So pool, the pool is closed in some areas. And what are we going to do with the pool? Well, can it be managed by someone at the property versus someone who's external, or can we have some savings in the contract? Maybe they don't come out as often because it's not being used. So there has been a netting effect. And in one particular property that I just reviewed earlier, you know, there is a net income. You know, there's actually a surplus right now because that netting effect is not as large. You know, the expense of COVID is not as large as the amenities that they've closed and the renegotiated contracts during this time that they've been able to manage.
And Monty, with you and I had conversations months ago about this. You know, back in March and April, the CARES Act was a hot item, but we ran out of money and there hasn't been a new stimulus package approved. But a lot of the questions that came up at that time was, do HOAs and condos qualify for the PPP program that's part of the CARES Act?
No, I mean, they've been excluded, although we know of one that did receive it, and we suspect it's because there was a commercial part of their operations. Unfortunately, they're not covered, and we'll see what happens in the future. But you know, to the extent that any HOAs are bold enough to try to have their own payroll, that's another story. But generally speaking, you're not going to see it.
Another question that came up, can a board amend their budget in the middle of the year?
Yes,
Yeah.
there's a process for that. And
Yes.
have you done that with some of your associations, Roxana?
We have, and it can be amended, but the same rules apply. 14-day notice if it's an HOA, if it's a 718 condo. And the impact is that you have to determine, are you retroactively doing this and charging everyone for the, you know, few months of that increase or change, or are you going to spread it from the moment that you pass the budget to the end of the year? So it's a little disruptive, to be honest. Amending a budget is not ideal because some owners will get the message, some owners will not, and then we have a lot of collections that happen into 2 to 3 months down the road. So
and there are times when it's really the only answer from a tax perspective. So it's just something to consider in terms of a huge surplus that where an association cannot file the 1120H. And so we recommend way before the end of the year, maybe amending the budget. So that's just some facts to consider. And I know that Roxanne and Tim are familiar with that process, but a lot of folks are not. And so I know you monitor that as we do as well.
yeah.
So here's a question, a couple more questions that came in. One of the questions came in, maybe this is for you, Roxana. Do many communities accrue for the replacement of landscaping? Basically, almost have a reserve study for landscaping, knowing that certain plants have a certain estimated life, and then they plan for replacing all that.
Yeah, we you know, a few years back, there was a property that wanted to add landscaping to reserves. And it's absolutely allowed as long as your document says that the association is responsible for landscaping, which it was, you know, it's part of their common elements and duties to replace landscaping. Is there a life to the landscaping, which you alluded to just now, that exceeds 1 year? And you could possibly say for many plants and many replacement items in landscaping that it does. It lasts for X number of years. Again, your engineer or your, you know, even your landscaper can ask, you know, that question. And what is the estimated replacement cost? It could be as simple as an allowance for landscaping replacement, or it could be very specific to the area, to the type of replacement that has to happen. So yes, definitely I've seen that and researched it to add it to a reserve in the past.
All right, great. And then one other question for you, Roxana, relative to expenses, because we haven't talked about payroll impact yet. Why is it important to try to get the payroll amount right, especially the timing of the year, if there are going to be increases? How does that impact the overall budget?
Yes, so something that we do, and as a recommendation, if it's possible for, boards to do, is a market analysis, because it's not about the person that's filling the position, it's about the position. And if you need to replace that position, what will it take in the market to do that? So we do a market analysis in each of our different, counties that we're in, and we want that effect. Are we paying the right amount for this position? Not necessarily the person that's filling the position, but the position itself. And if we ever have to replace it or something happens, or do we have enough dollars in the budget for that replacement? So that's how we approach the payroll in the budgets.
And that's a good point, because over the last 2 years, when unemployment was so low, we saw wages just continually increasing, especially a lot of the hourly rates, people making $12, not making 15 or 16. And
right.
To get good quality people to provide the level of service you're looking for in your property, you've got to pay market rates. So now with the big drop off and with unemployment going up so quickly, I think we can catch our breath a bit. And maybe 2021, we can kind of hold fast to what we have been using for at least the last 6 months or year.
Mm-hmm.
I don't think we have to expect these big increases until the economy kind of normalizes again and we start racing one more time.
Yeah.
So with that, Bonnie, a question for you. As we go through the budget process, your firm probably does, as many audits, if not more audits than anybody in the state of Florida. So what advice, best practices would you give a board in the budgeting process that could help prepare for the audit process at the end of the year?
So when you do put forth a budget, make sure that it's representationally faithful to your community. That's what your responsibility is. And then the second component of that is the component of monitoring that budget and making sure that you or a board, that somebody on the board or actually all the board reads the monthly financial statements and acts on it. And you can explain the variances and you can forecast the amounts for the rest of the year. This is other people's money. They depend on you to do that. You can't say, well, because we have the best treasurer in the world, that we don't have to do that, because we may take issue with your comment about the best treasurer. They may be a good politician or may have been a very good CPA in their line of business, but homeowner associations, condo associations are very unique. There's not any other, there's no other industry in the country for which that sets aside reserves for future replacement. There's no other industry in the country that typically has special assessments and can just raise the assessments for the expenditures. There's no other industry in the country for which you can predict what the revenues are going to be on the financial statements at the end of the year, except for the association industry, because as to the operating budget assessment should be exactly the same amount that's shown on the financial statements at the end of the year. So my best recommendation to you is to be cognizant about it. And at all times, I just have to throw this in, be empathetic to the people, whether they agree or disagree with you on what you have to say. You have to tell the truth. You have to put forth the facts there. You can't you can't just go ahead and just pretend it's not there. It will come out. So when someone does agree with you, just be empathetic. We're in tough times here. I've never seen a situation where there's been so much issues with people having mental health issues, being depressed there. So if we look after each other, we're going to look after ourselves. That's the only thing I would add to that discussion about what the board should do in terms of the budgets.
Okay, a couple more questions that I've seen here. Harold is asking a question, maybe more of a comment, that he's seeing that legal has gone up as a result of COVID. It could very well be the case for some properties, but again, depending on what your management company is doing, you may or may not have to rely on your attorney. If the management company has proper protocol, there's hopefully you're not spending too much more money on COVID. And then Renee has made a comment that there's a amendment on the November ballot to increase minimum wage to $15, and is that being considered in the budgeting process? I would just say to that, Renee, that most of the positions that that we see are paying about $15. There might be a few that pay 13 to 14, but for the most part, $15 is almost the minimum level that we're seeing in the properties that are being maintained properly. So that shouldn't have a significant impact. We do see properties from time to time that underpay from the market, but that will catch up to those properties eventually. And then finally, there was a question from Susan in Fort Myers, and she said that basically she's asking, she believes that literature dictates that, budget development processes show that cities that get more citizen involvement get more support from their citizens, and it's all about education. So she's asking, it seems to be most budget processes are closed to everyone except the finance committee and treasurer until it's time to vote. And then when we have the workshop, no one shows up because it's already done. It's a done deal anyway. What do you think about a more open process, and how would you structure it? So I don't know if either one of Roxana, if you want to take a crack at that one.
In our practice, and KW's recommendation is that all finance committees, all budget committees are open to the public. And I've been to many, and they, usually on the West Coast, there's a lot of participation. And it's good because we set the rules in place at the beginning, right? Where we need to do some work first. Let us discuss the budget, and at the end, we will call you if you have a question. When we start talking about payroll, then we go into a closed meeting, and that's when every owner leaves, because when you start talking about payroll, there's a statute that says that you could have a closed door meeting because now you're talking about, employee salary. But up to that point, the meeting should be open. They shouldn't be closed to owners. They should be open to owners every single time that you meet as a finance committee, as a budget committee, or even if you're meeting with a couple of people on the board that have the responsibility for the budget. They should all be open to the owners. And that's why we begin in August. Again, it's about timing. It's about giving time to the process and giving time to the finance budget committee to review it. We literally have 2 to 3 meetings to get to the final end results. So you can't assume always that it's gonna take just one meeting, especially since we have COVID, the unknown, factor into 2021. You should give yourself time so that you have multiple meetings, 2 to 3, and they're open to the owners.
Monty, any comment on that?
I couldn't agree more. I think that was very well said. When you're transparent about everything other than payroll, obviously, it's very important people have the opportunity to listen and contribute. And if they don't take that opportunity and they don't like the results, well, they can only blame themselves.
All right, well, we have gone over time as we usually do, but I want to thank you guys for hanging in there and being so involved in this process today. It was a great discussion on budgets. A couple of recaps from my perspective as far as best practices. Timing is probably the most important thing. Get started now. It's now budget season. Don't wait too long because you do have to get your coupons ordered and get those mailed out for those properties that have coupons, and most do. So don't delay. Try to get your budget done by, at the very latest, the end of October, so that the finance committee and budget committee can approve things, get the board to approve it, get everything out to the association, and get coupons so that by January 1, you know what you're going to be paying. Because there's nothing more aggravating than getting a notice on February 2nd that says you were $50 short because there was an increase in your budget in January and you're just now finding out about it. So timing's important. Talk to your vendors. That's very important. Don't be afraid to call your vendors. Find out if there's going to be an increase and how much that increase is going to be. That's very important. And then make sure you understand your requirements on reserves and how you're going to handle reserves in your community, whether you're a special assessment mentality or you have the culture of having reserves. Make sure you have reserve study updated every 3 years. That's going to be the best way for you to keep, make sure you have the right amount in there, and manage your contracts effectively, ladies and gentlemen. If you manage your contracts, there's a lot of opportunity for savings. That's one of the things that our value optimization team works hard to do to help our customers save money. So with that, I would say that we had a great session today. We talked budgeting with the 2 industry experts on this topic. I don't think we could find anyone that could do a better job. I want to thank Monty Kane, principal of MBAF, and Roxana Dorigo, executive director and partner with KWPMC. Good luck to all board members as you prepare for your 2021 budget. Be sure to rely on your management team as you create your budgets. Please remember that if you weren't able to make it today, or you want to let somebody in your board know about this session, it is recorded. You can watch this broadcast again at KWPMC. We have a YouTube site now. You can find things on YouTube, and we're more than happy to send you the link. We look forward to having all of our listeners join us again on September 17th as we continue to talk best practices for community associations. From all of us at KW Property Management Consulting, let's all do our part to reduce the spread of COVID-19. Wear your masks, social distance, and wash your hands. Monty and Roxana, thank you so much. You guys were awesome.
Thank you. All the best to everybody.
Fun. We could talk for 2 hours. We should have had a 2-hour session.
Yes, I know. We should have done that, but we will limit it to an hour and 15 minutes today. Thank you all so much. Next month, we'll bring on more Benny Goodman to entertain. Thank you.
Be safe, everybody.
Bye. Thank you.
Bye.